No, specifically, we won't be able to share any specific around this due to it being competitively sensitive.
Got it. On the quick commerce side, I had one question. Obviously, your contribution margins have improved meaningfully, partly due to ad income, and then you would also got some operating leverage, right, on the dark store level. But one thing that I'm not able to reconcile is there have been meaningful increases in your supply chain business. If I were to look at from a Q-on-Q basis or a Y-on-Y basis, the losses in those businesses have increased meaningfully, whereas your top line continues to grow. And my understanding was like there would be some operating leverage in that business, given that initial investments we are done with. So just wanted to see if is there any overlap between your Instamart business and supply chain business in terms of cost as well as revenue, and how should we read? I mean, how should we read that? Going ahead. Yes.
Sure, Swapnil. So thanks for the question again. So on the supply chain and distribution business, as we have mentioned in our letter, it is a B2B business where we are delivering to wholesalers, retailers, and kiranas, including housing of the Link business that we acquired last year, which is into urban distribution, technology-led urban distribution for the FMCG companies. So here, most of our near-term effort has been in expanding the overall capacities by introducing warehousing as well as logistics services. And that investment has been made, and we do believe that sequentially from here on we will see continued improvement in the profitability trajectory for that business segment. So most of the near-term investment are behind us, and sequentially we should see an improvement in this business going forward.
Right.
Also to note that today, if you have seen in our business, we already crossed the 1 lakh unique customers that this business segment directly invoices to. And we expect to continue increasing the share of the Kirana business in this segment.
Right. But the related question to that was like, what are the overlaps in terms of cost with your Instamart business? I mean, do you use the same warehouses, or do you use the same minimized logistics? How does it work, or do you have separate teams altogether?
So as we have mentioned, the Instamart sellers today use certain services of our platform. Warehousing is not one amongst them. But as we have increased our overall capacities and increased the warehousing infrastructure, we do expect to utilize to make the Instamart sellers also utilize some of this warehousing space. That will have a consequent increase in our take rate in the business. So as we expand our overall service offerings in this segment, we do expect to leverage or make use of the capabilities they have built in this business for the Instamart sellers also.
Got it. And just one last one, if I can squeeze in. So while we saw a meaningful improvement in your contribution margin this quarter in Instamart from 3.2 to 1.9, your guidance seems to be a bit conservative for break-even. Any particular reason that you want to call out over there? Why? Because if take rates are expected to increase, one would have expected most of that benefit to flow through your contribution margins.
Sure. So Swapnil, you're right that we have been able to showcase an improved trajectory in our contribution margin profile with better utilization and cost reduction in the business, and as well as increasing take rate. I think Harsha talked about some of the near-term competitive intensity we have seen. We are also expanding significantly our dark store infrastructure network in the near term. And so all of that is factored in our overall guidance of CM break-even by in another 4 quarters or the December quarter of 2025.
Got it. Rahul, thanks a lot for taking my questions, and all the best.
Thank you. We'll take our next question from the line of Vivek M. from Jefferies India. Please go ahead.
Hi, good evening, team. Couple of questions. The first question is on the, so your food delivery business, I know still is at an early stage, but you are sizable player with with sizable GOVs. What is the trend that you are seeing on the ground? Because a lot of consumer companies are talking about slowdown. The quick service restaurant industry has been dealing under pressure with the SSS number negative. What is, if you can just talk about how the landscape is on the consumption side, that will be very useful.
Hi, this is Rohit here. So, while I think obviously we have also read in about overall slowdown and some sectors slowing down, it looks like we happen to be in three categories where we are not seeing that impact play out, at least in the last quarter or even at present. So if you see, food delivery has grown about 5.6% quarter-on-quarter. Instamart is growing 24% quarter-on-quarter. Dine out, which is the out of home category, has grown about 11-12% quarter-on-quarter. So, and even if I reflect on what's happening right now, we don't see this pattern playing out. So one of two things, it could be that these sectors are more insulated from some of the slowdown discussion which is happening, or within the food space itself, online delivery is slightly pacing ahead of overall food market growth. Market growth. Could be that playing out as well.
Got it. And just as a follow-up, so when because beyond your numbers, you will be, let's say, meeting the restaurant partners, talking to them. Do you think there is or do you get a sense that there is the partners are, let's say, going through a bit of a slowdown pressure right now, on the dining side of things?
Actually, on dining side, what is reflected from our business, because that's what we concentrate on, we are not seeing that happen. The dine out business, or the going out business, which is large part is actually dine out, has grown about 11 to 12% last quarter, and seeing pretty strong momentum there. So it looks like at least the segments we are exposed to at present, at this point in time, are pacing well.
Right. But, my question to you is, when you talk to restaurant partners, do they complain about, things being slow on the ground, or you also don't get that sense from their side?
Again, very segmental, because there's nothing called a restaurant partner. There are QSRs, there are chains, there's a kachori shop. Everybody's a partner. We have few lakh partners on the platform. I think maybe it depends. Few segments are definitely, they talk about some slowdown happening in the category, but also the slowdown at an individual player level may not happen because the category is slowing down, but also new competition is coming up. So, for example, there are cities where, assume there was one pizza player, two pizza players who used to dominate. Now there are like 20 pizza players in the market. So it's also the slicing of share which is happening, interstate between those players, which could be reflecting on individual player discussion as you speak to them, versus the overall category being impacted per se.